Most new investors approach the stock market like a casino, reacting to flashing red and green lights with a mix of anxiety and hope. But the people who actually build lasting wealth in the market operate entirely differently. They rely on strictly defined, emotionless systems. By the end of this video, you will have built a personalized, written, beginner investor action plan. We are going to establish a set of rules to govern your trading so you never have to rely on guesswork or luck. To build this, you only need two things. First, a physical notebook or a blank digital document. Second, $500 to $1,000 of risk capital saved from your salary to fund your initial account. Writing these rules down physically is your first line of defense. It forces you to stop hoping you'll make money and starts you operating a resilient, mechanical financial system. Let's build it. Step 1 is establishing the vessel for your investments. When you open a brokerage account, you will face a choice between a cash account and a margin account. You must explicitly select a cash account. Take the time to vet the firm. If you use a full-service broker, speak to the office manager. Ask about their track record, make sure they are generating positive returns for their clients, and verify that they use high-quality, institutional-grade data sources for their research. Whatever you do, avoid margin at this stage. Investor William O'Neill noted how highly intelligent, educated people were completely wiped out because they invested on margin and had no sell discipline. Borrowed money accelerates losses far faster than a beginner can react. Selecting a cash account serves as the bedrock of your defensive strategy. It makes it mathematically impossible to lose more capital than you originally deposited. Step 2 limits your exposure. Once your account is funded, write down a strict limit for yourself. If you have $5,000 or less, you will own no more than 2 stocks at any given time. A common error is attempting to buy a few shares of 20 different companies. That dilutes your focus and weakens your overall returns. You must concentrate your limited capital to see meaningful growth and effectively monitor your positions. Step 3 is setting your minimum price filter. Write down a firm commitment. Never buy a stock priced under $15 a share. This protects you from the penny stock trap. New investors often feel a psychological urge to buy a large block of $5 or $10 stock simply because they get to own hundreds of shares instead of just a handful. But the market operates as an auction. The massive mutual funds, pension funds, and banks, the institutions with buying power to drive a stock's price up, consistently invest in higher-priced, high-quality issues. They actively avoid cheap, speculative stocks. By valuing the quality of the company over the sheer quantity of the shares you hold, you align your strategy with institutional momentum. This brings us to step 4, the single most critical rule for wealth preservation. You must establish a non-negotiable trigger to sell any stock the moment it drops 7% to 8% below your purchase price. Human nature will actively fight you on this. When a stock goes negative, your ego wants to defend the original purchase. You wait, hoping the price will bounce back so you don't have to admit a mistake. That hope must be systematically eliminated from your process. This chart shows the math of ruin. By enforcing a hard 8% downside ceiling, your capital remains largely intact. But if you let a stock fall 50%, a 100% gain is required just to break even. Taking a quick 8% loss is exactly like paying a minor fire insurance premium. You pay a small, controlled amount up front to guarantee your entire portfolio doesn't burn to the ground. Add that absolute rule to your plan. Finally, step 5, set up your feedback loop. Create a dedicated daily chart or a spreadsheet to log every single trade you execute. You need specific data points for this to work. Beyond the stock name and the buy and sell prices, you must explicitly document your precise reason for buying, your reason for selling, and the lesson learned from the trade. As a new investor, you will make mistakes and you will take losses. That is the normal tuition you pay to the market. But logging those details ensures you identify your personal bad habits, like ignoring your 8% rule, instead of repeating them blindly. This post-trade log acts as the engine of your improvement. It transforms temporary financial losses into permanent, profitable lessons. Look over your completed list. If you followed these steps, you now possess a defensive, institutional-grade action plan. You have a funded cash account, a strict 2-stock maximum, a rule against buying penny stocks, a non-negotiable 8% eject button, and a tracking log to audit your decisions. By defining and writing down these parameters, you've already won the hardest battle. You have successfully removed hope, fear, and ego from the equation before you've even purchased a single share. Your immediate next action is to research top-performing sectors to find those first 2 companies. Keep this action plan visible at your desk at all times, and whatever you do, never break that 8%.